Welcome back to the Noob Selling Options channel, everyone. Today, we're going to tackle a thought experiment that might sound a little bit crazy at first, but I promise you, it has some massive implications for how you think about your portfolio. We are going to dig into a question that seems impossible. Why would a perfect, all-knowing investor, I mean, literally a god-tier stock picker, almost certainly get fired?
It sounds absurd, right? I mean, how could perfection possibly fail? But this very question is at the heart of a classic paper in behavioral finance from Dr. Wesley Gray. And the answer, believe me, it reveals a really powerful and frankly uncomfortable truth about our own psychology as investors. So the experiment kicks off with a simple but brilliant idea. Imagine you hire a fund manager who is omniscient, all-knowing. Let's just call them God for simplicity's sake. This manager has perfect foresight and can infallibly pick the absolute best performing stocks for the next 5 years. No mistakes. So here's the strategy. Starting way back in 1927, this manager buys the top 10% of U.S. stocks that are guaranteed to have the highest returns over the next 5 years. They hold them for 5 years, cash in those massive gains, and then just repeat the process with a new batch of perfect picks. And the long-term returns? They're absolutely astronomical, crushing the market beyond anyone's wildest dreams. Sounds like a perfect strategy, right? Well, this is where the paradox comes in. Because while the long-term results are absolutely flawless, the journey to get there, well, it's brutal, it's agonizing, and for any normal human client, it's psychologically unbearable. So even though our perfect manager knows the ultimate winners, this portfolio is not some magical shield against the market's gut-wrenching volatility. Knowing exactly where you'll end up in 5 years doesn't stop the terrifying stomach-in-your-throat drops that happen along the way. The study showed that this so-called perfect portfolio wasn't just volatile, it was absolutely terrifying. It went through numerous, frequent drops of more than 20%. And look, these aren't small dips we're talking about, these are full-blown bear markets for this portfolio. But oh, it gets so much worse. There were these agonizingly long stretches of time where this perfect portfolio was down a whopping 40%. While the rest of the market was actually making money. I mean, can you imagine the sheer frustration of seeing your friends' regular portfolios grow while your perfect one is just bleeding out? And during the big ones, the extreme market crises, like the Great Depression or the 2008 crash, the God portfolio experienced drawdowns of up to a staggering 75%. 75%? That is a catastrophic paper loss, even if you know with absolute divine certainty that a full recovery is guaranteed to happen. So here's the bottom line, the crucial point. In the real world, no rational client would ever endure this kind of pain. They'd look at their quarterly statement, see they're down 40%, and they would fire that manager in a heartbeat. And in doing so, they would completely miss out on the massive world-changing recovery that was guaranteed to come. Perfection gets fired because the path to perfection is paved with human panic. Now, this isn't just some fascinating, dusty academic thought experiment, not at all. It's a powerful lesson that holds a mirror right up to modern investors, especially for any of us invested in today's most volatile, highest potential assets like AI and crypto. A concentrated, high-conviction portfolio in game-changing tech, that's our modern-day equivalent of the God portfolio. It's a strategy designed for massive, decade-long returns. And just like the God portfolio, the non-negotiable price of admission for those returns is extreme volatility. We're talking about the brutal crypto winters and the gut-wrenching tech corrections that can shave 50% or more off your value in a flash. And this brings us to the biggest risk you face. It isn't a market crash. It isn't a bad earnings report. The single biggest risk to your long-term wealth is your own reaction to the market. It's the very real danger of firing yourself. This self-sabotage is driven by this powerful cognitive bias called myopic loss aversion. See, our brains are hardwired to feel the pain of a loss about twice as intensely as the pleasure of an equivalent gain. So when your portfolio is deep in the red, it triggers this primal biological fight-or-flight response that just screams at you to sell, to do anything to stop the psychological bleeding. And firing yourself by selling during a downturn has two absolutely catastrophic outcomes. First, you guarantee that what was a temporary paper drawdown becomes a permanent real-world loss of your capital. It's gone. And second, you will almost certainly miss the rapid, unpredictable, and powerful recovery phase, which is where the biggest gains are often made. So, knowing all this, right?
knowing that our brains are basically wired to make the worst possible decision at the worst possible time, how do we build a mental fortress? How do you actually engineer the conviction you need to stick with the plan during that inevitable turbulence?
Well, here's a practical three-step process. First, accept the toll. Don't just tolerate volatility, expect it. You have to mentally accept before it happens that a 40, 50, even a 60% drawdown isn't a sign of failure. It's the standard fee you pay for admission to the land of outsized returns. Second, focus on cash flow. This is huge. Use option strategies, like the ones we talk about on this channel, to keep your analytical mind engaged and, honestly, to distract yourself from those scary paper losses. And third, trust the macro. Stop watching the daily price ticker. It's just noise. Focus on the big picture, the decade-long signal. At the end of the day, you have to remember this. Your high-conviction portfolio, whether it's in AI, crypto, or the next big thing, it's a high-octane engine. The research, the fundamentals, the math, it all says it's built to reach its destination. The single greatest danger is you, the driver, losing your nerve and ripping the steering wheel off during the turbulence. So the question I'll leave you with is this. You've built the engine. Do you have the nerve to see the journey through? If this explainer helps strengthen your conviction, do me a favor and hit that like button. And be sure to subscribe to the channel for more content to help make you a smarter, stronger investor. Thanks for watching.